So as Jan said, my name is Mathieu Martin. I'm a portfolio manager for the Rivemont MicroCap fund. We are based in Montreal, Canada. So a quick disclaimer before I start, this presentation is for informational purposes only. These are not recommendations or investment advice. And if I talk about companies, which I will, Rivemont may hold positions and may trade on these positions at any time without prior notice. So I'll just start by giving you a little bit of background about myself. I started investing in microcap companies about 8 years ago in 2014. And before that, I used to be an online poker player. And so that's where I developed my risk-taking skills, learning how to manage a bankroll, and also, most importantly, learning how to manage my emotions. And so I've been used to dealing with a lot of volatility. And at some point, I was looking for ways to invest my capital that I had won playing poker. And one of my friends, Philippe Bélanger, who's also a member of the MicroCapClub, he was already investing in microcap companies, started about a year before. And so he told me about the strategy, and I instantly figured out that I could develop an edge in this market. So in poker, you're looking to play against weaker players, so you make better decisions than them over the long term, and you end up being a winner. Well, in the stock market, it's the same. If you play against lesser skilled investors, like retail investors or people that do it part-time, that don't have all the time to do their research properly, that's where you can develop an edge. And so I started doing that with no finance background. I didn't study in university. I just started reading books, attending conferences, and speaking with other investors, developing my network. And I would say it took me approximately 2 years to really figure out a winning strategy. And I think that it's something that's pretty unique about my background, is that I really started from a blank slate with no finance background at all. So I just figured out on the ground in my local market in Canada how I could develop a winning strategy from scratch. And in parallel, Philippe and I started a blog called Space Microcaps, which some of you may know. And we shared educational articles and some of our investment ideas to build a public track record. And eventually that led me to start the Rivemont MicroCap Fund in 2018. And in parallel, I also got my CFA charter. So now I have a bit more of the educational background as well. So a quick snapshot about the fund. It currently has 12 million in assets under management. We started with about 5 million initially, 24 positions, and it's fairly concentrated strategy with 51% invested in the top 5 holdings and over 80% invested in the top 15. And in terms of sectors, we're heavily invested in technology and healthcare. So this is a quick presentation, so I'll just go through a sample of some of our most important criteria. So in terms of must-have, we want a company that can compound its value by more than 30% per year. And I know that's a very high bar, and we're very selective, and we won't always be right. So at the portfolio level, if we find a few big winners that can compound their value by that much or more, we should do well over time. And then we look for positive cash flows or a clear path to it. So it's very challenging for microcap companies to get financing, and especially in tough times like right now. And so we want to avoid a refinancing risk. So we want companies that can self-sustain themselves. Then we look for clear competitive advantages. And typically for microcaps, it's in a specific niche of the market. So we want them to have a specific expertise or maybe a patent or some kind of regulatory approval. something that makes them unique and hard to replicate for their competitors. And hopefully this small moat can expand over time. And finally, we look for an outstanding management team, ideally with skin in the game. So we always talk with management before investing. We meet a lot of management teams over the course of a year. And if we don't like the management for some reason, or they have a shady past or something, it's a no-go for us. We don't compromise on that. And then a few nice to have. We want a company that's predictable and easy to understand. Just because it makes our lives easier to evaluate them, but also because I think the market eventually pays a premium for companies with those characteristics. So as they grow and they execute, there's a better chance that we get a multiple expansion over time. And then we want to find them undiscovered with low or no institutional ownership and analyst coverage. And how we're able to do that is by staying small. We only have 12 millions of assets under management. We intend on staying a small fund. And so that way we can keep investing in the really, really small microcap companies in Canada and find them before the larger institutions. I think our criteria are fairly simple. It's a simple strategy, but it's not easy because you get pulled in all directions. There are a lot of investment opportunities out there. I get a lot of ideas from my network, and I think it's hard to stick to your strategy, stick to your criteria, and really know what to avoid. And so we've put a lot of emphasis on figuring out what we should avoid. And so we avoid natural resources because I don't like the commodity risk. So that's about 2/3 of the Canadian market is natural resources, and we avoid that altogether. Then we avoid pre-revenue or unprofitable companies, again, because we don't want the financing risk. We avoid story stocks with no track record. And for those who know a little bit about the Canadian market, once every couple of years, we get a big trend, big fad, like we had cannabis and blockchain and plant-based foods and things like that. And so when there's a big trend like that, a lot of companies are looking to go public and raise capital based on mostly stories. And initially they perform well when the bubble is inflating, but then inevitably they all come crashing down. And so we just try to avoid those fads. Then we avoid roll-ups, and it's a lesson I learned the hard way. And we still own a large position in the roll-up, but I realized over the years that executing a roll-up strategy as a microcap company is very challenging because you are always needing to raise more capital. And if you don't have a good multiple in your stock price, it's not attractive to do so. And so your growth is slower, it doesn't excite the market as much. And so it's very challenging to execute this as a microcap. And I haven't seen a lot of examples where companies have been successful doing that. And finally, we avoid, for the most part, IPOs and RTOs because typically the financial forecasts and expectations are inflated. And I've studied our track record investing in IPOs and RTOs, and almost every time we would have been able to buy the stock or cheaper with better fundamentals within the next couple of years after we went public. So let's move on to my current topic. The company is called Microbix Biosystems, MBX on the TSX. It's about a $74 million market cap company. And full disclosure, we own it in our fund. It's actually our largest position. So what they do is they are infectious disease testing specialists. And it's not, unfortunately, it's not a very simple business to understand at first. And I'll try to run through it quickly, so bear with me. The company started about 30 years ago, and for most of its life, what they did is native antigen production. So the first point on the left. So an antigen is the ingredient that goes into a diagnostic test. So for example, you do a COVID-19 rapid test. The ingredient that's inside the test that will react if you have the disease is called an antigen. And so Microbix manufactures antigens for many different diseases, for many different test makers. And so it's a key ingredient that goes into the test. It's a small input for a very small cost, but a very important piece of the test. And so that's why they are able to have pricing power. The flip side, what's unfortunate about this business is that it's a slow growth industry, mid-single digit market growth, and it's a small market. And so Microbix used to do 12 million in revenue in 2019, and then COVID happened, and a lot of the testing capacity worldwide was repurposed for COVID testing. And so some other tests were impacted, and the revenues declined to about 8 million this year. We think this will recover eventually in the next few years and should resume growth at mid-single digit rate. Then in 2017, a new management team came in, a new CEO actually came in, and he looked at this business and the expertise they have in producing antigens for multiple decades. And he said, what can we do with this? How can we leverage this expertise to develop new business lines? And so the first thing they did is they developed a new business line called CAPS, or Quality Assurance Products. Now, instead of manufacturing the antigens that goes into the test, they do a quality control product for laboratories that run the tests. And so, for example, every 25 to 50 tests that a lab will run, they can use a Microbix quality assurance product to test if their equipment is working properly. So they will input a known positive sample and a known negative sample and make sure to get the right result. If it's not the case, they know the equipment is not working and they've been providing wrong results to the patients. And so they started selling those products in 2019. They did about $1 million in revenue, and now they're up to $6 million in revenue this year. And they just announced a new contract for $5 million more going into next year. And so I believe this business should do well over $10 million in revenue next year. So this is a very fast growing business, and it is the main growth opportunity. If you look at Microbix today, I think this could be several tens of millions of dollars of revenue over time. And finally, the third business line, when COVID started, there was a lot of testing for COVID, and one piece of a test that's really important is the small vial of liquid. So when you get the swab in your nose, they put it in a vial of liquid to stabilize the sample before it gets sent to the lab. This small vial of liquid is a regulated medical device. Most of them are in Canada. Actually, most of these devices are imported from Europe or Asia, and there are no domestic suppliers of this in Canada. And so the province of Ontario approached Microbix. They said, you have the expertise to manufacture that. We'll give you a grant, build a manufacturing facility, and supply us. And so Microbix did that in a few months. They set up the manufacturing facility, and they've been generating about $5 million in revenue from that, just selling to the government of Ontario in the last couple of years. And now they're expanding their capacity to be able to sell to other provinces as well. So it's a competitive market, and there might be oversupply at some point in the future as COVID testing declines. But we think that being the only domestic supplier in Canada is an attractive value proposition, and they should maintain a good market share here in Canada, but it will be lumpy. So I'll just run through my criteria that I mentioned previously to help you understand why I like this opportunity. So in terms of compounding, their revenue grew 77% last year, and EBITDA grew over 1,000%. So there is fast growth and operating leverage, and I think the fast growth can continue with the caps division. And it's also trading at less than 15 times EBITDA. So we have the potential to see a multiple expansion over time if they execute well. Then the company is profitable. They generate over 20%, 25% actually EBITDA margins. They have competitive advantages. First of all, the expertise that they developed over the last 30 years is quite unique. It's also a highly regulated industry, so they have ISO certifications and regulatory licenses to operate because they work with live viruses and bacteria. So it's something that would be tough to replicate for a competitor. And finally, they have some intellectual property that they develop in-house, and also they license some unique IP from partners. And finally, the management team is outstanding, in my opinion. I've met with the CEO multiple times, and I think he has a lot of intelligent, fanatic characteristics. If you just listen to some of the earning calls, you should understand why I think that. And lastly, in terms of nice to have, unfortunately, the company is not super predictable as of now, but it's getting better. It's improving. It's still a bit lumpy, but as they sign more long-term contracts, multi-year contracts for caps, I think this business will become more and more predictable. And it's also, unfortunately, I think not so easy to understand, but if you spend enough time, I think it's quite possible to gain a very good understanding of the business. And lastly, it's not undiscovered per se. It's been around for a long time. They've been public for, I believe, 20 years, but they've always failed to generate enough revenue growth to really get investors excited. Previous management also invested in some projects that didn't pan out and that basically destroyed shareholder value. And so I think it has a bad reputation. And hopefully under the new management team with a renewed growth strategy, they can execute and get rediscovered again by investors. So that's pretty much it. If I don't know if we have time for questions. If anybody wants to reach out, please feel free to do so. And I'm also a blacklist on the MicroCapClub.